I like the fact that you kept the difficult question for me. I'm not sure this is something that's less than debatable. And I also would like to hear Farouk's take on that, because his team, not immediately his team, but his colleagues, has put a price tag at the end of 2026 of $6,000 for the gold. I definitely will start from a position where I do challenge that. I think today, in today's market, gold, and I said that a few weeks back, is overbought. And there's a very simple, I understand the structural forces that led to gold being what it is right now. Definitely one of that is the trade war and the uncertainty, which might not be necessarily reflected in the VIX, how the VIX move, but there is definitely uncertainty. The only thing here is that the markets got used to uncertainty so that the VIX readings came down, but there's still uncertainty, and that drove a lot of structural buying into the gold. This is one thing. The other thing is that the speculation that took place as central banks were buying gold, there are a lot of speculators dancing around this theme and started buying gold, which all of them pushed the prices up. But there is, let's go back to fundamentals. There is a very fundamental fact here, which one person tipped me a few years back on, which is look at what is called the gold backing. What is the gold backing? It's basically the money layer, or the M2 globally. If you took that one of the most effective 7 nations in the world and you divide that by the reserves under the ground and above the ground of a gold, you get to a number. You divide that number by the price, and it gives you an indication of where the gold is right now. That number, if you divide it, it would be a range between the 7 to the 8, that is the historical 20 years average for this ratio. Today it's at the 2 level, which is a big indication that the gold, relative to the available money reserves globally, is way overbought. And hence, by virtue of this being a mean reversion indicator, you can see that the gold at some point will face a lot of resistance around that level and is bound to go down before it goes up again if it ever reaches that 6,000. And this is generally my take into where we should be expecting the gold. I was a big bull on the gold at definitely the 2,000 level, the 2,500, and when the trade war started. But today at these prices, I'm not sure that the path to 5,000 or 6,000 is so easy. Well, I'll start from where Kareem ended, which is basically the next year or the next period, we'll see outperformance of emerging markets versus the US and some of the developed market. We have seen the US and Europe actually has done a staggering comeback in the last 12 months. I think for all of the reasons that Kareem cited, I believe that emerging markets as an investment class will outperform. But again, this is not going to be homogeneous. This is not going to be across the board. There will be markets that underperform, markets that will outperform, and definitely markets that will remain in line with the overall performance. If we look at Egypt, I'll start with Egypt. I think Egypt has done in the last period most of what is needed to start attracting back capital and have all of the macro indicators has improved significantly. Yet, you need to look at Egypt still if you're going to discuss the equity market from the perspective of an equity investor. Now, the equity investor looks at size, and size matters a lot for these markets. You cannot ignore the devaluation that has taken place over the past few years, which has reduced the size of some of the companies that they look at and some of the turnover that they look at. I recite a conversation between me and Kareem in 2002 when we first met back in New York, and I was pitching him one company, and he told me, look, does it trade less than $10 million a day? If it trades less than $10 million a day, I won't be able to buy it because the minute I go in, I'll take the stock up 4 or 5%. This is not something that I do. Now, if we look at this $10 million a day...
We did.
Yeah, that And that was back in 2002. Now, if you look at this today, this is the equivalent of roughly $500 million. 500 million pounds. Now, how many stocks do trade 500 million pounds a day? Only until yesterday, perhaps with the resurgence of a couple of stocks, we didn't have any. I mean, it happens every now and then, but not a lot. So again, this is a challenge. And the only way to fill this size gap is to continue with these consistent reforms that will empower growth in these companies, keep the currency where it is, and the market will start re-rating and then attracting, once again, the large foreign institutional investors, because they are the bellwether, or they are the balance into these markets. And we have seen them, frankly speaking, exiting, not coming over the past period. Now, if you look at the other markets, which is the Gulf markets, Saudi, obviously with the mega fiscal stimulus that they have been putting in place in the last few years, Saudi has become the most active capital market, not just in the region, but perhaps in entire emerging markets. There's an IPO or a couple of IPO, maybe 6 IPOs every month. There is, all of the big money is moving there. And by the virtue of this, you will have to have a re-rating. The CMA has been engaging with investors, deregulating the market, opening up to things that hasn't been thought of in the past. And you have seen money flowing, and for sure the valuation is going to be higher than what it was over the past period. It has seen its fair share of beating, but it's coming back. And I think also 2026 is going to be a year where many of the Saudi equities are going to re-rate. UAE has been steady, increasing slowly but steadily, less volatility, and it's been one of the most stable markets over the past period. And I don't see any reason why should that change. So overall, these 3 markets that you mentioned, I still believe that they are going to be the core of performance of this region for the next period. That's a very difficult question. I mean, in a global context, obviously the merits or the advantages and the disadvantages of AI are very clear. But when you look at it from an Egypt context, it's a little bit tricky because one of the significant advantages that the AI is given is efficiency, and enhancing efficiency means some job creation and some job destruction. But again, we cannot look at AI and say, okay, AI will destroy jobs for the world. I mean, that's the same argument that you had back in 2000 with the internet, and everybody thought the internet will definitely destroy jobs. But between 2000 and today, the job market globally has grown by more than 60%. Now, also back in the 80s, the same argument went with the advent of computers, the PCs. Everybody thought that they will destroy jobs, but they created jobs. So, but not necessarily the same job was created, but because of increasing efficiencies in certain areas, there were jobs created in these areas and jobs destroyed in areas. But overall, the job market grew. If you look at the advantages, the labor market, the Egyptian labor market is still in an area where AI is not going to impact that significantly. So still, in that regard, if the question is, are you afraid that AI will destroy jobs, and that's Egypt's most inherent advantage, which is very economic labor, the straightforward answer is unlikely. But AI, let's not forget that, is very dependent on power. And without power, AI cannot, because AI is increasing significantly the demand for electricity, the demand for energy globally. And this is a region that's awash in energy, and Egypt is no exception. So again, Egypt has some advantages locationally, geographically, and in many areas that can use AI in improving. But I think the more interesting question in that is how Egypt today, with a technology stock that it has, or technology inventory, is ready to receive AI.